And in the shareholders' equity, of course, we can have different types of equity. We can have preferred equity, we have common equity, common or ordinary equity. We're going to have something that are called treasuries. We're going to have something called retained earnings, etc. Got it? Now, the relationship between liabilities and shareholders' equity, just to let you know, this is called the capital structure. So all this part here. So basically, the relationship can be this minus this, or the ratio of total liabilities to shareholders' equity. This is called the capital structure of a corporation. Okay, so this is basically the relationship between liabilities and equity.
Sorry, when you mean by relationship, it's liabilities and equity, or it's just the
it's a relationship.
No,
it's a relationship. So for example, there are two ways of measuring that. Liabilities minus shareholders is one way of seeing that. But a common way of seeing that is liabilities divided by shareholders' equity. Got it? So for example, if you have a 60% liabilities over shareholders, so it implies that you have $6 out of 10 that comes from debt versus 4 from equity. And then you have some corporations that is the opposite. You can have a 0.3, for example, means that or let's say $3 come from debt and $7 comes from equity. Right? So this is simply the capital structure. So you can have basically corporations, guys, that this line here can be very low or can be very high or can be in between. Okay, so any possible combination here is possible. Make sense? So let's talk a little about specific components. Let's talk about the short-term assets. So remember that everything that is short-term is simply referred to liquidity. So it's very liquid. Okay, so what we can name here is obviously what is the most liquid instrument that we have? Cash. Agree? The second most liquid is accounts receivable. So this is basically, we give credit to some of our clients that they're going to pay us in 30, 60 days. Then we have, of course, inventories. So if you, it depends on what type of corporation you have, but if you have some inventories, okay, so the inventory is also your short-term asset, because the idea is that you have this inventory and then you're going to sell this inventory. Right? Now, in general, inventory, guys, also can be classified as raw material. So this is what you use to produce something. Something that is called inventory in process. So this is something that you already are transforming. So this raw material is being transformed, and soon it's going to be a final product. And then finished products. Basically, these finished products are the ones that are ready to sell. Got it? It is very important, guys, to be very careful when you have inventory, guys. You need to be very, very careful not to have a lot of raw material. Do you agree? Because raw material implies that you cannot sell this really at a market price. So you have it there, but as soon as it's not transformed, so the value added of this raw material is very low. So what you want is turnover. So you want to have raw material, process immediately, and have a finished product that you can sell. Okay, so this is an art and a science, guys. Inventories, I worked in inventories when I was in the Air Force. My first assignment was working with inventories. I basically managed inventories for almost 1 year. It's, you know, it looks easy, but it's extremely complex. Got it? Okay, and then we can have also, of course, corporations can invest in other corporations. Do you agree? So if they have cash, so instead of having the cash in the bank, they can have the cash in, for example, in assets. Okay, and this is called short-term investments. Short-term investment is simply investments that the corporations have in another corporation. And normally this is very short-term, it's 1 month, 2 months, 3 months maximum. Okay, so now if we talk a little about the long-term assets. So when we talk about in accounting about long-term things, guys, it's more than 1 year. Right? So what lasts more than 1 year? Of course, land, buildings. You know, we have equipment. These are the tangible ones. So these are also called tangibles because you can touch them, you can see them. And you also have something that are called intangibles. That is what is known as a goodwill. Patents, for example. You know, brands. If you have Coca-Cola brand, of course, just the Coca-Cola brand is worth billions. Licenses. So if you are the only one able to sell some products in a given country, this is also a value for you. Do you agree? So if you want to sell your corporation, that per se has a lot of value. Make sense? And of course, here we're going to have something that is called accumulated depreciation. We're going to talk more about what is depreciation, but it's simply the payment or the recovery of investments of the owners, right? If I invest in a machine, you know, I can recover this investment in 20 years, for example. Okay? And you're going to see how the people and the corporations use depreciation to pay less taxes now versus the future. Right? We're going to discuss that in short. Okay, so these are basically the short-term assets, long-term assets. So we can now discuss about the short-term liabilities. In the short-term liabilities, guys, of course, we have accounts payable. Okay, so this is what you owe to your suppliers. You need to pay them in 30, 60 days. Then we have here, sometimes we have something that's called taxes payable, for example. We're going to work on more taxes payable. And then you have salaries payable, etc. So everything that is short term will be considered in here. Got it? Now, in terms of the long-term liabilities, guys, remember, long-term implies liabilities. Long-term simply implies more than 1 year. Okay, one example of long-term liabilities, guys, is something that is called bonds. And we know how to price bonds. We know how to understand how coupons, yield to maturity, all this stuff works. So we are very proficient working on this stuff. So we're going to be very proficient on computing interest rates on accounts payable or in accounts receivable. Okay, so all the interest rates, all the techniques that we have been using, guys, allows us to basically understand how this works very easily. Make sense? And of course, in shareholders' equity, guys, we have some of them. Something interesting here. Okay, so we have here, of course, shares. And shares, guys, in general, okay, I'm not going to be discussing a lot. In general, we have common stocks and we have prefers. Now, what is a common stock? It's a simple share. So you're the owner, you have the right to one vote, one share. You can be part of the board of directors. And if you're part of the board of directors, you can basically participate in the decision making of the corporation. Okay, so for that, you normally need to have a very decent number of shares. But more and more now, guys, the board of directors is named by professionals. It's managed by professionals. So even though you're the owner, you can hire professionals that are going to do the job for you. Okay, and preferred. What is a preferred share? They normally have preference in two things. In time when there is a sale of the property, they are going to have the preference to be paid first, and preference in dividends. Okay, so they can receive dividends before the common shareholders. And of course, sometimes they don't have voting powers or deducted voting powers. Right? Then we have from shares, we have something that are called sorry, treasuries. So what are treasuries, guys? Are simply shares that a corporation buys by itself. Okay, so this is the famous buybacks. Have you heard about that? Now it was buybacks. So this is very famous now. So corporations have had so much money that instead of investing in other corporations or instead of investing in inventory, they have too much money. So what they can do is they can start buying their own shares. Do you see?
This is the tool to increase the stock price, right? Without
well, this is one of the tools, exactly, because you are increasing the demand of your own corporation. Do you agree? So this is one of the things that happen. So you buy yourself, so you are increasing the demand of your own shares, so the price goes up. Okay, and the other thing is that you're using liquidity, and that's a complaint of some people in the government saying, wait a second, guys, you were in troubles, we help you, and you use that money to buy back your own shares. So that's not logic because you're not growing. So you understand, guys, that by buybacks, the corporation is not growing. Make sense to you guys? So it's changing money for paper. The corporation is not increasing the assets that allows them to produce more. What they are doing is simply recomposing the composition here, recomposing cash, less cash here, for more treasuries. That implies less shares in the market. Got it? Make sense? So this is a complaint. So there is no value added, technically, guys, when you buy back debt. Of course, the people argue, well, no, but there is a value added as because if we buy our treasuries, it's because we trust in our corporation. Okay, yeah, can be. And also the other reason that they argue is that they are buying that because they have so much cash that they cannot invest in the corporation. Got it? The counter argument of that is, okay, guys, but you know what? What you can do is you can invest also in other things, in other type of projects. You can do research and development. You can do a bunch of things with these guys that can allow you to develop the business. But corporations are basically saying, no, I just want to buy back. That's it. I don't care. And there is no law against that, guys. Okay, so buyback is completely managed by management, by the board of directors. So if the board of directors and management say yes, so they can go and buy these treasuries. and of course, later we have something called retained earnings. Retained earnings. Okay, so I put a star here because the retained earnings, guys, is the way in which the balance sheet communicates or relates with the profits and losses. Okay, so my asterisk here comes from P&L.
I'm sorry, the retained earnings comes from P&L?
Yes, profit and losses. The P&L is the profit and losses. Make sense? So let's describe briefly what are the profits and losses. So let me move this somewhere around here. So now let's talk a lot. So remember, guys, that the balance sheet, just to remember, let me write this one here. So this presents the financial situation. Okay, financial situation of a corporation at a given point in time. Okay. Now, if we talk about the second financial statement, is basically my P&L, what is called my profit and losses. Okay, in short, P&L. The P&L, guys, has this basic structure. So we have revenues, and then we subtract the cost of goods, what is called the COGS, okay? So it's cost of goods. So everything that is related to produce your final product or to produce what you sell. From here, if you subtract this minus this, you have the gross profit. And then if you subtract management, how much you pay the people to manage the corporation. So all the related activities that allow you or help you to do this gross profit. So for example, here we have marketing. Here we have depreciation. Okay, if you subtract this one here, what you obtain is earnings before interests and taxes. Okay. After this, you have, of course, you do financial costs. You subtract. Financial costs are basically interest rates. And I will put this in parentheses, gains, because sometimes you also gain, guys. As soon as, remember, you're having short-term investments. So imagine you invest in commercial paper, 3% per year. And so you're going to make money from here. So this is an interest that is positive for you. Do you agree? So that's why financial costs, parentheses, gain. So this can be positive. So if it's positive, this is a plus here. If it's negative, it's a cost you are paying for debt. Okay, this is going to be a negative here. Make sense? And then if you do this, you have your earnings before taxes. Of course, you subtract your taxes, and then you have your profits. Okay, in general.
Sorry. So I'm assuming the difference between the gross profit and earnings before interest and taxes is that so it's more or less a salary of and
Yeah.
the piece of
So
like the human capital, while the cost of goods is like from physical, tangible
products, yes, yes. But also in
materials
the
and
cost
stuff.
of goods, remember that the cost of goods also, so imagine you're producing, tables, okay? So the payment, for example, for the carpenter that really works on the product, this is cost of goods also. So the wood, the nails, the painting, the labor that is directly related to the production of the good is cost of goods. Okay, but also remember, you also have salespeople, you have marketing people, you have finance people, you have all these other activities in a corporation that help the corporation to work. You see that? The support part of the business is this part here. Depreciation, guys, is simply to return what the owners invested in machinery, land, etc. Well, no, not land, because land is not depreciated, but equipment, buildings, etc. Oh, I forgot. Oh, no, this is land, buildings, and equipment. That's correct. Okay. And what do you do with the profits, guys? Or what do corporations do with the profits?
Either reinvest or
Exactly. So if
buyback.
if corporations want to reinvest, okay, so this is where it goes here. Okay. So this reinvestment is called retained earnings. And of course, what you can do is you can simply pay dividends for the owners, right? Makes sense to you? Questions, guys, up to now? We're going to start working more in details on this stuff, but questions?
Professor,
Yes, Maria.
so we said that if there are short-term investments, obviously they go under short-term assets. What about long-term investments? That is also possible, right? To
Yeah,
hold
it
like a
is.
stock of some other company, for example.
Yeah, it is. But you know what? Normally, the corporations don't have long-term investments because there is a discussion here. Why if it's a short-term investment, so this implies that you're having a holding. Okay, so let me explain. Let me finish this part here. Let's talk a little about holdings. So a holding, in general, guys, is a corporation whose main goal is to make investments. Got it? So, for example, I create holding ABC, and holding ABC invest for long term in corporation XYZ, in corporation PMQ, and corporation. So they create different corporations, and every single corporation that is below the structure, it is something like the one we have. Only does short-term investments. Got it? The logic is the following. So why a corporation should do something that the owner can do by himself? Got it? My corporation is created to do tables. Okay, I specialize in doing tables. Why should I be, as a corporation that produces tables, be investing in a corporation in Tesla, for example? A long-term investment. I can do this short-term because I have a lot of cash. I can do this for 1 month or 2 months. Of course, Tesla is too risky, but in any case. But why investing in Tesla for 10 years? It doesn't make sense. In that case, better if you give the owners the profits, the dividends, and they can do this by themselves. Of course, there is taxes involved here. Okay, sometimes the owners prefer to have the corporations to do that, just not to have dividends because they have a lot of money. They don't want to be taxed more. However, the IRS, guys, is very keen and is very hard on long-term investments on corporations. You need to have a reason. So if you're producing tables and you want to invest in Tesla, they're going to argue. They're going to say, wait a second, this is not your goal. Your goal as a corporation is to produce tables. So they can make you troubles. But everything has a solution. And the solution is basically to create a holding. So, and you can create a holding that is just doing investment in Tesla. You can call your corporation Tesla Investments Limited, for example. You can do that. And so you fund, as a holding, you fund your Tesla Investment Limited. And what is the goal of this Tesla Investment Limited? Simply investing in Tesla. Okay, so in that case, it's clear. But if you create one corporation that's tables and you want to invest long-term in another corporation that is doing completely different stuff, no. Now, the other thing is that perhaps you say, you know what, I want to invest long-term in another corporation that is building chairs. Well, in that case, tables and chairs is good. But then you need to be very careful because IRS is going to be saying, what type of investment you are doing? If you are more than 10%, so this implies that you are a stakeholder, a significant stakeholder. So this can be assumed to be like an acquisition, a significant acquisition. So this is taxed differently. Right? So you just need to be careful on that. But there are a lot of rules and a lot of things you can do in corporations. Okay, guys.
Sorry, so like a holding company is like Alphabet.
Yeah, exactly. Alphabet.
And Google's like one of the corps.
It's one of the, yeah, and Alphabet has tons of. PepsiCo, for example, guys, is another brand. So PepsiCo has Pepsi Cola. They have Doritos, and each of these, no, not Doritos. How do you call Doritos? Doritos, Fritos, all this snacks. So they have one division of snacks. They have one division on water. They have divisions on the beverage. They have tons of small corporations, but the holding is PepsiCo. And also it's better, guys, because you know what happens if you have a holding. The holding has a group of owners, but each individual corporation can have also the same owners, but can have different ownership also. You see? So it's easy. So if something goes wrong with Pepsi Cola, okay, Pepsi Cola disappears, but the holding PepsiCo stays there. Make sense? So, and that's very usual in the market. And there are, of course, a lot of tricks there when you have holdings because you can move, if one corporation is losing money and the other corporation is making money, so you can do some tricks there that you charge one and the other one pays the other one in such a way that the net is zero, something like that. Trump is very, very good in that. But that's completely logical and it's completely, it's legal, okay? So we need to be very careful on that. Legal is legal. So you can do that because it is in the law. Now, ethically, I don't know. But in any case, what is the third financial statement, guys? is basically the cash flow. Okay, and in the cash flow, guys, I will simply mention the following. Don't confuse profit and losses. Profit and losses has accounts that are not cash, and we're going to discuss this later, okay? Some of these ones here are not cash. But the cash flow is purely cash, it's money, okay? And how do you create cash in a corporation? Well, you create cash in a corporation by operations, so you sell and the people pay you cash. So this is the cash flow coming from operations. You can also bring cash to the corporation by a loan, financing. You agree? So you go to a bank and ask $10,000. The bank gives you $10,000. This is cash that comes to the corporation. This is also cash. And finally, this comes by investments. So you don't go to the bank. You look for new owners, new shareholders, and then simply they contribute cash. And this is also another way of getting cash flows. Got it? So these are the three financial statements, guys, that we're going to be working and presenting during this financial analysis part of the class. Make sense? Questions? Clear? So let's do now, let's warm up first and let's understand how this works, okay? And let's talk a little about what happens when the people say, this guy is not, Amazon is not paying taxes. Have you heard about that? Amazon is producing billions of dollars in revenues last year and pay almost nothing. Why? And the people really complain about that. And the explanation is very simple, guys. I will tell you in 1 second. The explanation comes for, if we start focusing our attention for a minute.
Isn't this like because they're being, I think, a tax credit for all of their investments?
Yeah, of course, exactly that. Of course, so basically depreciation. Okay, so now let's take a look to something that is called the tax shield. Okay, so what is a tax shield, guys? It's simply something, is an expense that reduces taxable income. Okay, so that's the trick. So let's try to find an expense that reduces the taxable income. Of course, one of them, okay, one of them, guys, is created by depreciation. Okay, so let's do one example. So let's assume that I have my P&L. I will say my P&L without depreciation, just to show you how this works. And let's do a P&L with depreciation. Okay, so let's do here, for example, my revenues. Let's create my revenues. Imagine are $1,000 or $1 million. Also here. Imagine that my cost of goods are $300. So what is my gross margin, gross revenue? Well, it's going to be 700. Do you agree?
Yeah.
Okay, so let's assume, guys, that I have management and others. So I'm just accumulating all of here. And let's assume that also we have 300. Okay, and let's write here depreciation. And let's put here 0 first. And then, of course, here, what I have is my earnings before interest and taxes. Okay, sometimes it's taxes and depreciation, EBIT. So what I will have here is 400. Agree? Then imagine that I pay interest payments. So let's assume that you have an interest payments of 50. Okay, so basically your earnings before taxes are going to be 350. And then imagine that you have your taxes, and let's assume tax is 20%. It's 21, but let's assume 20%. So you pay $70 taxes, and then your profits are going to be 280. Do you agree? Now, guys, I want you to pay special attention to this number here and to this number here. Okay. So what happens, guys, that if indeed you have $100 of depreciation? Okay. So just let me delete this part here. Let me put this in red. So now you have $100 in depreciation. So what is the impact of $100 of depreciation? Of course, now your EBIT is going to be only 300. It's going to be 50 here. So I will have only 250. If I do 20% of this, I have 50. And then I end up with 200. Correct? What I want you to see, guys, is this part here. This is what is called the tax shield. So how much less I'm paying here? 20. Do you agree? This is what you're paying less in taxes. And how this 20 comes from, where this 20 comes from? Well, it comes because I have done a depreciation. Make sense to you? And if you realize, guys, this 20 is exactly the same, equal to the depreciation times the tax rate. Now, remember, guys, that here you can see, hey, wait a second. Yeah, I'm paying less taxes, but I'm getting less profits. Yeah, of course. But remember, guys, that the profits are going to be lower, but the corporation keeps this $100. Okay, so this is a non-cash transaction, for example. It doesn't mean that the corporation is going to disappear this $100. No, the corporation has $100 for doing whatever they want, you know, repair or perhaps improve new technology, etc. So we have it there. Okay. So now let's, and I want you to understand this because you need to be very proficient on discussing this stuff. One, well, I will leave some space here. One business that is well known in countries like Peru, South Africa, etc., Philippines, etc., is mining. Do you agree? So let's do one example with mining. So what happens with mining, guys? Mining has a lot of different stages. Do you agree? So if you do a timeline of a mine, you have an exploration process. Agree? So you find a land and you believe there is gold. So you have done satellite images. You go into the place. You dig to find mineral in the place, and then you realize that yeah, you have gold. Once you have this one here, so you have everything that's related to implementation, building, the camps, the mines, etc. So give me 1 second. So here is basically the building. Okay, and exploration includes permits, licenses, includes a bunch of other things. And once you are here building, okay, so then you start the production phase of the business. And normally we're talking about 30 years or something like that. 10 years sometimes, but 30 years is reasonable. Make sense to you? Now, guys, take a look to the logic in mining. And what is the main complaint of mines? It's more or less the same complaint as Amazon. If you go to developing countries, the people always complain. And also the governments complain. These miners never pay taxes. They have invested $3 billion in my country. They are getting a lot of revenues and they pay almost zero in taxes. Why is that? Given this example, how can you explain that?
Depreciation?
Yes, but what is the logic of depreciation, guys? It makes sense or not? So tell me one thing, where they invest a lot of money?
The building.
In all this part here, guys.
The building, because they have to erect the facilities and infrastructure.
Exactly, but also in the exploration, because you spend a lot of money really in exploration. So, and remember, the exploration is money at risk. So you can invest millions of dollars and then at the end of the day, there is no gold. or the law of gold is so small that you don't, it's economically infeasible. Non-feasible, not infeasible, not feasible. Makes sense? But the bunch of money that they do is they invest at the very beginning. Got it? And then what happens when you invest at the very beginning? This number here is going to simply go up, really. And what happens when in the production side, the production in a mine, guys, is more or less like any business. So at the very beginning, you produce very low, because you are building the tunnels, I don't know, or you are cutting the mountains, etc. So you produce your sales, your revenues are very low. And then this goes, and then in time, this ramps up. This goes to a peak, and then this starts decreasing again, and then you go like that. This is the time frame of a mine. Got it? So now, imagine what happens during the first years of production. So that these revenues are going to be small, and these depreciations are going to be big. So what is going to happen? Not only zero, you're going to be losing money. Make sense to you? So if you lose money, guys, remember corporations can simply move these losses for the next year, lose the losses for the next year until they start making money. So governments, the governments that are very unlucky, seriously, are the ones that arrive in this part here of the production. So if they arrive in these years of the production, they are not going to see anything, and they are going to be complaining and say, these miners are stealing our gold. These guys are simply doing terrible things, and they are paying nothing. You see? But they talk, and the only way they can simply enforce payments is if they do something that is nationalization or statization, etc. Because legally they cannot do anything. Because technically, guys, what these miners are doing is simply applying the rule. I have low revenues, well, because I'm here. I'm in this part of the equation. I have low revenues. But why do you have so much depreciation? Well, because you know what? I'm depreciating everything that I have invested. So it's a huge money. So and this number can be negative, and this number can be rolling out for 10 years easily. So governments for 10 years are going to see zero. Make sense to you? But this is logic. It is correct. Now, there is another trick that the miners use, guys. And oh, yeah, okay, so let me put this in the perspective of, no, let's finish the miner idea. Something that is called, how do you determine how much money you're going to depreciate? Okay, so in depreciation, guys, there are basically two techniques. Okay, one is the linear. Well, you say simply, you know what, the cost, imagine it's $3 million. The number of years to depreciate this one here. So, and this depends on countries, guys, depends on if you're talking about equipment, if you're talking about software, it's 3 years. If you're talking about building or construction, you can go up to 20 years, 30 years in some countries. So let's assume that the number of years to depreciate this one here is 30 years. So your annual depreciation is going to be simply 1, 2, 3, 4, 5. 1, 2, 3, 4, 5. So this is what you're going to depreciate per year. Make sense? However, there is another technique that is called in advance or accelerated depreciation. So I will do one example later in the class, but accelerated depreciation means simply, guys, if we do the linear, it's going to be 100, 100, 100, 100, 100, 30 years. Do you agree? This is the 100K. This is the linear. The accelerated depreciation, guys, depreciates a lot at the very beginning and then basically goes something like that. This is the accelerated depreciation. So why, and normally I haven't seen a country that doesn't, the tax code does not accept accelerated depreciation. Why? What is the logic of accelerating depreciation? Is basically what you're saying is that at this point in time, guys, remember when these guys are restarting production, they need a lot of cash. Corporations need a lot of cash. Do you agree? Because they need to start building up. They're not selling as much as they want. they're going to be there, but they need a lot of liquidity here. So one way of supporting these businesses is basically, okay, I allow you to accelerate your depreciation. At the end of the day, you're going to depreciate the $3 million. It's the same. But instead of depreciating 100, 100, 100, 100, you want to depreciate, for example, the first year, 1 million. The second time, 700. And then you do this progressive decrease like that, right? And where this appears, this accelerated appreciation appears, guys, it was basically during the Great Depression in USA. No, the government was saying, how do I help the corporations? How do I make these guys to get more cash from what they produce? Okay, let's help them with accelerated depreciation. And by the way, this was supposed to last 10 years, but this lasts up to our time. Okay, and corporations are making use of that, of course, because guys, if you do a time value of money, what is most useful for you? If you have a 50% return, for example, of course, have the cash now. You see? Then instead of having 100, I prefer to have my 1 million because this can produce much more money than $100,000. So the corporations have an incentive to do that. Make sense to you guys? Make sense? So this is one of the things, and if you put this into perspective of not only mining, I will put here, I will talk about Amazon now. So Amazon, guys, is exactly the same. Tesla is exactly the same, but instead of exploration and building, they have a lot of research and development. They do technology, new technologies, they test, they fail, create again. So they have a lot of monstrous investment here. Amazon, for example, is buying a new fleet of planes. Amazon is building from zero distribution centers. So they are buying, warehouses. So they are investing tons of money. Make sense to you? So even though their sales, their revenues are great, of course, Amazon is not like that. Amazon is much faster than that. Even with these huge, enormous revenues, given the investments that they're depreciating, so the taxes at the end of the day happens to be almost zero. Got it? So we need to be very careful when the people start talking, these guys are not paying, etc. Be careful because legally and structurally, and there is a logic that you need to follow. You can analyze these type of things very simply. That makes sense to you? Don't go just on the political discourse, go into the technical discourse, guys. Make sense?
Professor, I have a question. So
yeah.
if this is not, if in case of Amazon, it's not depreciation, let's say where that money goes. So in case of looking at profit and loss statements, that would be, that money would be reflected in management / other, or?
Yeah, but yes, if it's not depreciation, and then you see that these guys are reducing this, but yes, management and all these guys, this should increase a lot.
Yeah.
Okay. Now, yeah, of course. This is your thing. Okay, let me put here. You got it. Also, another way of decreasing, but this is good. I believe R&D is good, if well done, of course. One way of reducing taxes also is increasing R&D. Do you agree? Because this is an expense. And expenses reduce the base, the taxable base, and so the taxes go down. But this is good because you know what? If you're investing in research and development, so this implies that you're creating new stuff. You're creating value for a corporation that in time they're going to pay back to you. But remember, guys, the most tricky part of every business is research and development and explorations in mining, because you can invest a lot of effort, a lot of time, and really nothing happens. We have done a lot of investments in mining, a lot, and this exploration takes a lot of money and funds and time and frustrations, because you can believe in something that at the end of the day is nothing. Okay, but that's it. Make sense to you guys?
Sorry, and then I'm assuming the logic to why governments allow tax credits on depreciation, it's because to encourage them to invest in the first place?
Yeah, of course.
Okay.
Of course. That's the idea.
So all countries do that?
Every single country does that. Every single country does that.
Okay.
And there is competition between countries, and the competition, because remember, countries, they aim for investments. Do you agree? Why they aim for investments is labor. So they use people from their countries. Technology. So they want to have technology. And there's a competition, guys. It is like, in Latin America, I've seen competition between Ecuador, Peru, and Chile for getting corporations, getting big investments. So they compete. One way of competing is, of course, they say, you know what, I will not charge you 20%, I will charge you 10% for the first 10 years and 20% after that, or I allow you to do this type of accelerated depreciation. There are a lot of things that the governments try to do to attract investments, right? And you see that also here in USA, guys, when Amazon said, okay, guys, I will do my new headquarters. You know, New York was offering $2 billion in tax rebates. Other states were offering different stuff, you know. It is a competition. Now, the thing is that the discussion now is really healthy, this type of competitions, because at the end of the day, who's the winner? The corporations. Of course, the countries also win, but the corporations receive these huge tax breaks that are insane sometimes. And the OECD is what they are trying to do, and of course there is a lot of opposition because you don't imagine the amount of money we are talking about here. What they are trying to do is they are trying to standardize. So for example, they say, okay, you know what, buildings of these characteristics for this industry, maximum depreciation years 20. That's it. Everyone should apply 2020. Imagine, they eliminate the accelerated method of depreciation. So if there is no government, no country that offers that, that's it. So governments can have a maximum number of years here. They don't simply suffer from this type of things here, etc. Right? But up to now, guys, the efforts are almost zero. No, there is a lot of efforts, but results zero. And then you can imagine, we live in a world of lobbyings and you know, different points of view, and that's the word. That's the way it works. Okay, hopefully someday. Make sense? Everyone? Okay, so now let's go and let's take a look to another thing. Let's take a look to this one here. So let me save this one here. Perhaps better I clear this one here. So there is another thing, guys. Let me see. There is another thing that is called, let me move this. That is called leverage effects or financial leverage. Okay, so what is financial leverage, guys? It's something cool. So imagine the following example. You're going to recognize this example. So imagine that you invest 100 and then you receive 150. Okay, so what is the internal rate of return here? Let's say 1 year.
50%.
Mm-hmm. Well, what you have done is simply saying, you know what, 150 minus 100 over 100, so I get 50%. Now, is there a way in which I can increase this one here? Can I increase this one here? Can I increase this one here? And a similar question is, can I reduce my exposure? My risk exposure. Because remember, guys, you are here, do you agree? This one here is if you have done a correct, a proper analysis, this is likely to happen. But imagine if you decided to open a restaurant on February 2020, you know, you hired a fantastic chef, you're in the best place in Manhattan, you pay a lot of rent, but you know what? You're going to have the clients are going to be there because you have the right product, the right place, etc. March 2020, coronavirus came, and then that's it. Boom, out of business. This happens, guys. You know, we need to be used to that. Of course, coronavirus is something exceptional, but this happens, right? So this is a kind of a dream, an educated dream, right? So what you try to do, just one second. So what you try to do is try to reduce your exposure. But you know what is interesting? How do you reduce your exposure? So you basically, two things. You look for a partner or you look for debt. Agree? So what you do normally is, and that's it. So you increase you increase debt. Okay, so basically you borrow money. So let's assume, guys, that you have someone is going to, you get debt, you get 30 at 5%. So imagine you go to a bank and then you get $30 at 5%. Got it? So now let's analyze that the business. So you are going to go, so the 100 investment is 100, but here from this 100, you're going to have $30 from a loan and $70 investment. So at the end of the day, how much do you have? You have the 100 that you need, correct? So you have this 100. However, guys, take a look to what happens in the future. Okay, in the future, assume that I get my 150. Make sense? Now, from this 150, how much I need to pay to the, so from this 150, I will put this here. How much I need to pay to the bank? I need to pay 30 times, so this implies a T1. I need to pay 30 times 1.05, correct? So this is around, what is that, 5% of 31.5?
Around that. 10% is 3.
Yeah, 31.5. I need to pay $31.5 to the bank, correct? Okay, so from this 150, I subtract 31.5. So what I get? So it's 118.5. Please help me with that. 20, yeah, it should be. Agree? So now my question is, what is your return? How do you compute that? Basically, my cash flow now, guys, if we do only my return, so my cash flow is indeed 70, and then I get 118.5, correct? This is my cash flow, my own cash flow. Agree with me or not?
Yeah.
So this is basically your own return. This is leveraged. You compute this as usual, guys, is 118.5 minus 70 over 70. Can you tell me this number?
$0.69.
So 69%? Okay, perfect. So you compare this number here, guys. 69% versus 50. Can you increase this 50%? Yes. How? Financial leveraging. Do you see that? Second question, can I reduce my risk exposure? Yes, you answered this one here. So if the business went wrong here, you lose 100. If the business goes wrong here, you lose only 70, technically. Make sense?
Mm-hmm.
And perhaps you can use the remaining 30 for another project, guys. You see, if you have another alternative that produces more than 5%, instead of using all your money in this project, come on, get the loan at 5% and invest the other part of your money in another business. So that's why you need to be very smart playing with this stuff. And you need to be rich to do this stuff. You can do that, okay? Questions?
Professor, when you say that if you lose Without a loan, you lose your $100. But if you lose with a bank loan, then you just lose 70.
Right.
Yeah,
if
but then
there's
you also,
complete collapse, no, if there's complete collapse, of course, yes, of course, the
You
30
have to
is going to claim. But if you're a corporation,
Yeah.
I'm sorry, you just take everything you want. I have nothing. You're saying that's right. Corporations, remember, protect personal unless you do something legal. No, remember that corporations protect the owners. If you collapse for like coronavirus, I open my restaurant, for example. Let's assume I open my restaurant here.
Mhm.
I got $30 loan from the bank, and I collapse. It's not my fault, you know.
Mhm.
So then the banks immediately are going to write this off. This is going to be a loss
Oh.
for them because they understand. You know what? Yeah, no, and they see it is clear. So why I will sue these guys? Well, perhaps I can get the tables and the chairs and try to sell them. I can try to do that, but normally banks simply write it off. That's it. It's part of the business, so they know it. So that's why, in order to provide you these 30, they do an analysis of everything, and perhaps they ask for additional collaterals, etc. But makes sense to you?
Take that collateral, yeah.
Yeah, exactly. And they can take collateral just to protect themselves. It's just to be sure that nothing goes wrong. Of course, that's impossible. Nothing goes wrong. Questions, guys? No questions? It's clear? Okay. So now let's start talking about what we're going to be doing this class and next class. So let me clean this part here. Guys, we're going to start working now with these three financial statements, okay? And remember, guys, that you can learn, this is a regular accounting class, and you can take at least a couple of years to understand every single detail of how this works, how the major book, the T accounts, the debit and credits, and all this stuff. I remember taking that class when I was doing my master's on this stuff. However, there is a method that it is surprisingly easy, really, and I learned that method in a couple of days. I remember that I was doing I just finished university and I got a consulting, and the first assignment that I got was doing this type of financial statements. And I remember my first night, I went and I made agreement of consulting agreement, and more or less at this time, it was around 7 p.m. And I remember the owner told me, Eric, you know what, you can talk with the accountant that is just in the back of my office, and you can start talking with him and understanding how we want to set this up. And then I went to talk to the accountant, and it was like talking with a Chinese individual. I could not understand a single word of what he was talking, because they have their own language, they have their own slang, and it was completely out of focus. But I had a very short time to learn accounting, okay, and learn it very well and understand this very well. And this technique, guys, is the one that I will show you. I learned in 2 days. Seriously, and I'm pretty sure you're going to learn this in perhaps a little less than that. Okay, so what is this method? Okay, this method, guys, is called the Italian method. Well, I can do this. Okay, and the Italian method, guys, is going to provide us a method to immediately create the balance, the P&L, you're going to see, and the cash flow. We are going to learn a method that is going to provide us with these three financial statements immediately. Okay? You're going to see how easy this works. Now, the Italian method, guys, it was more or less in the 1600s, Venice. Merchants, of course, they need to keep track of everything they do. So what they realize is the following. And remember, guys, that the financial accounting And accounting has been for years of years. Romans use it, and even the people believe that Egyptians use this. Okay, so there is long history of that. So what they realize is the following. You know what is beautiful about accounting, guys? Have you taken any econometrics class? Yes or not? Yes. So
Yes.
when you write a regression, okay, so let's do this a commentary here. So when you have yt equals alpha plus beta xt, this is a regression, this is a linear regression or not? There is a missing component here. So what I'm, the what?
The error term.
Yes, we have an error term here. So we know that, so this implies the following. So basically, guys, imagine if you have a lot of, a cloud of points like that. So what we are trying to do when we have this type of model, if it's linear model, what we try to simply try to fit a line. Do you agree? And so what is this error here is that what we argue is that not all the points are in my line. So I can have some points that are above, some points that are below. So these are my errors. Make sense to you? So that's why econometrics, guys, is more complicated than accounting, much more complicated than accounting. Why? Because in accounting, this term here must be equal to 0. Okay? And where this accounting property comes. So in accounting, guys, we don't have econometric regressions. In accounting, what we have is an identity. So an identity implies that you must satisfy always this condition. If you don't satisfy this condition here, you're wrong. Okay, it is not like an econometric. So I have an error of 3. Oh yeah, that could be okay. In accounting, it's impossible. You cannot have an error of 3 because there is something wrong. Make sense? And if you know that there is something wrong, what do? Well, you start looking for where's my mistake. Do you agree? And then once you identify the mistake, you go back to the identity. And that's what we're going to be learning now. So, and what is that? The only trick in accounting, guys, is what is this identity? Where do I get an identity in accounting? Very simple. Remember my cash flow, sorry, my balance. You remember that? It was assets, liabilities, and shareholders' equity. Agree with me? Now, what is my identity? My assets must be equal to my liabilities plus my equity. Yes or not? Okay, so this is what these Italians discovered. And just by this discovery here, they created this method. And we're going to use exactly this identity to create this method and then create everything from there. Make sense to you? Okay, so now can we open, I send you guys, let's talk a little about what I have sent you. Give me 1 second, let me open first this one here. Okay, so new share. I have sent you a couple of documents, one Excel and one PDF. You see that? The PDF is the one that I used to use in class, because in class I do this in a Blackboard and you were supposed to do this by hand in your notebooks or in this page here. But also what is interesting about this PDF, you see my PDF, right? Guys, are you seeing my chapter 1, 12 basic principles?
Yes.
Yes, okay, so this is what Henry, this is the book of Henry, and I decided to use the same just to, for those of you that are taking Henry's class, you don't need to double your efforts here. So guys, if you can, we are going to do this, okay? We're going to discuss this and we're going to start implementing this. If you can please take a look to this, read these 12 basic principles. They're very simple, and then we can discuss them early next week. Right? Just read this. It's a 2-3 pages read, very simple rules. And then we're going to discuss, if you have questions, we can discuss them on next week. So let's try to start working on this part here. Now, what I've done also, I have sent you a file, an Excel file that contains exactly the same information, but it's in Excel. You see, this information here is what we observe in the PDF. And then what I've done is I've done a white document, and we're going to start filling this white document. And then from here, we're going to build our balance, P&L, and we're going to do some ratio analysis. Make sense to you? Okay, questions? At least let's do at least 10 today, and then tomorrow or next week we can finish that. These ones here and build all the financial statements and do more exercises on that. Okay, make sense? So what I've done here, guys, is let's take a look first to the. Are you with me in this field? You see this in my Excel file?
Yeah.
Are you with me? Yep, perfect. So what I've done here, guys, is I've defined my current assets. I define my fixed assets. I define my current liabilities. I define my long-term liabilities, that are these two guys. And I define my shareholders' equities. I have preferred stock, I have common stock, I have treasury stock, and I have retained earnings. The only trick, guys, that you need to always remember is that revenues and expenses, okay, the revenues are always positive and expenses are always negative. That's the only trick that you need to remember. Revenues always positive, expenses always negative. Now, this control column, guys, is the one that ensures that our identity is satisfied. If we get a different number from 0, there is a mistake somewhere. Got it? So this control column here is going to be providing you your check. Hey, guys, you are okay. Got it? Now, what you can have, guys, if you do this, at any point in time, you can have these totals here is what you have in cash. So let me perhaps, okay, let me move this here and do a split. So at any point in time, you can have this number here is what you have in cash. This number here is what you have in accounts receivable in total. You see? So these numbers here are simply the sums of everything. And if you are, for example, in 2/28/2019, you are here, you know exactly how much money you have, how much in cash you have, you need more cash, you need a loan, you need some whatever. This information here provides you, this line here provides you everything. Make sense to you? We're going to go into the details, but makes sense? Okay, yeah. So I think that's it. So we can start, I will do 5 or 3 or whatever, just to give you the feeling of how this works. And then you're going to start working on that alone. You're going to see that you can do this alone. Okay. Okay, guys. So I need to turn on my, or give me 1 second. I need to just to be reading from another. Give me 1 second. I want to open. Okay, perfect. Now, here we are. Okay, so we need
sorry,
to do
Dr.
this.
Ngifo.
Yes.
Did you say that you sent us this sheet by email?
Yes. No?
No, I didn't get it. No, I don't know about the others. I didn't get it.
Guys, have you get it or no? No. Perhaps I got
it.
I got it, yeah.
Yeah, I got it.
So Ithiel, can you, yeah, you should have received it, Ithiel. Can you take a look to that? Wait a second, I don't have you here. Why I don't have you here? Maria.
No, Ithiel is part.
You know, Ithiel, I don't have you here. That's interesting. In my, 1 second, I will, just give me guys 1 second. I want to be sure that everyone.
No, Ithiel's part. I saw his email in the material for our next class.
Yes, oh, is Ithiel here?
Yeah, they see it here.
Oh, you are Ithiel here. You are in the, I sent this on Monday, September 28th. Can you take a look?
Okay, I'll check.
Monday, September 28th at 2 p.m. Otherwise, I can resend this to you. So give me 1 second. Yeah. Yep. I resend this to you. Right.
Okay, no, thanks so much, Dr. Ngifo.
My pleasure. Yeah. What I was going to tell you. Okay, so now let's go to the, what is my Excel file? Excel. Yep. Okay, you see my Excel? So let's do the first transaction. The first transaction is I have an initial investment of 200, initial investment, we're going to have 200 shares at $1 each, okay? And this initial investment is divided in cash, 50,000, a building, someone give a building 100,000, and land 50,000. Got it? So we have these three how do you call it? 3 contributions. Okay, so how do we handle that? Well, remember, this is a cash transaction. Sorry, this is a new investment. So this implies that I should have, perhaps I need to do this. Yeah. So this is going to increase my stockholders' equity. Do you agree? And I assume that this is a common share. Each one is value 1. So this implies that I will increase here by $200,000. No. Agree? So I will increase my common stock in $200,000. So this take care of my equity side of the equation. Remember, I need to have something in the asset side related to this one here. Okay, so now we need to go and see how is this decomposed. Okay, I have $50,000 cash. Agree? And then someone contributed with land, 50,000. And someone contributed with a building market value of 100,000. Make sense? So this was equity here contributed to asset here. Make sense? Well, it's long-term asset basically. Now, are we satisfying our identity? Yes. You see that? I haven't modified anything. The sum of the assets equals the sum of liabilities plus equity. Make sense to you? You understand this transaction? So
Yes.
this is normally the way, guys, in which you create your corporation. You join between 3 friends and then 10,000 one, 5,000 euro one, and 9,000 euro one. You put all together, and some contributions, remember, guys, are not necessarily cash. Some contributions are basically, I put a couple of computers. I set a couple of computers, etc. Right? So this is the first transaction. Good. So let's do the second transaction. So the second transaction is I buy computers and other equipment for $10,000. So I will buy, computers and chairs and desks and perhaps a printer, etc. That's what you want to have. So this implies that you're going, and remember, I'm clear here that inventory is not for sale. So these computers are not for sale. They are part of your working equipment. So what I will do is I will increase my equipment in $10,000. And the question here is, how do I pay this part here?
The cash.
Aha. So what I will do is I will do a minus 10,000. I'm reducing my cash. Negative is reducing, positive is increasing. I am good or not? Because here, remember guys, here, this is an asset transaction. If you verify your transaction identity, yes, we're okay. Make sense? So let's do the third one. The third one is, okay, now I buy merchandise for $5,000. So this is going to increase my inventories, correct? So it will increase my inventories, merchandise for selling. How do I buy this one here? Remember, but by default, if the people don't tell you, I buy merchandise, and they don't tell you on credit or whatever, it is assumed the default is cash. Okay? So this implies that I have bought this one using using cash. Okay, here comes the things are more interesting for now. Questions up to now, guys? Clear? Okay, so let's do the third transaction. No, sorry, the fourth transaction. I will sell merchandise. Okay, all is going to be in cash, and they are going to pay me 3,760. But remember, guys, that the price of a merchandise, you also need to include the taxes. Got it? So what I'm telling to you here is the price of a merchandise per se is 3,497.67. Oh, perhaps I can show you. Yeah, and the sales taxes 7.5% equals 262.33. So your client is indeed going to pay you 3,760, correct? Okay, so let's first report that. How much I will receive in cash? How much I will receive in cash?
The entire 3,760.
Perfect. So this is what I will receive in cash. However, I know that this has two components. One is reducing my inventories, right? My cost. So this is going to reduce my inventories by what is my inventory here? Oh, sorry. What I'm doing here? Sell merchandise. Okay. So forget about this for a minute. So what I do with this one here is that part of this one here is going to be, give me 1 second, I need to read this correctly. Yeah. Okay. So let's do first the equity side of the equation. So this 3,760, what I need to do is I need to have something that is called, minimize this one here, sales tax payable. So I've created a sales tax payable, and this sales tax payable is going to be equal to 262.33. Do you agree? Guys, do you agree?
Yeah.
And what is the remaining part? The 3,497.67, guys. This is going to be a revenue. 3,497.67. This one here is my revenue. When I sell something, I hope that I have done a positive revenue. What this is saying here, guys, is that from this 3,700 something, I need to keep 262, that is for the government. This money is not my money, it's money of the government. And this one here is my revenue. However, guys, the revenue does not come from the air, do you agree? So I should have some costs related to this revenue. Correct, guys? And this is what is in the lower part. So in order to produce 3,497, my cost of my merchandise was 2,800. So this implies that for doing this one here, I have, I created one space here. Normally the people do in the same line, but just to show you, what I will do is I will do this in the following line. So I have minus 2,800. This is I'm reducing my inventories. And this is what? This is my cost, my expense. So that's why I was always telling you guys, revenues are always positive and expenses are always negative. Make sense to you? Can you take 1 minute to think about this transaction, because this is more serious transaction.
Sorry, I blanked out for a second. What you were saying. So this 2,800 is.
Is the cost?
What is this?
It's the cost of my merchandise.
Okay.
So remember, I'm selling merchandise. Do you agree? Mm-hmm. What I'm receiving is 3,760. I know clearly that 262 are for the government. I need to keep it just for the government. Normally, you pay this at the end of the month, guys. So you keep this for 1 month. or for as many days as you have up to the end of the month. But you need to pay it. This is not your money. So that's why you need to distinguish these taxes. This tax is not my money. However, from these sales, 3,497.7, this is my revenue.
Yeah.
Got it? But as soon as you have sold inventory, so this implies that you have an expense. This, in this case, this expense is a cost of goods, remember?
Yeah, so this would be like, yeah, I just realized that we don't have a cost of goods sold, like specifically that column.
Exactly.
And that's why it went into expenses. Okay.
Yes, exactly.
General expenses. And then we take it from the inventories.
Inventories, of course. We need to reduce my inventories because I now don't have 5,000. I have this minus this, that is 2,200 inventories.
Okay, I need to reduce my inventory as well.
Yeah. Okay, with number 4. Okay, questions. Let's do number 5. So now I will buy merchandise again, but in this case, I will buy not only cash, I will buy part in cash and part in credit, okay? 30 days, I will pay the remaining part in 30 days with no interest. So first of all, inventories. How much my inventories increase? How much I am buying on inventories, guys? Guys?
17,000.
70,000. Exactly. Now, the question here is that the relevant question here is how much is cash, how much is credit? How much is cash?
5,000.
5,000. And what happened with the 12,000 remaining? It's credit, so normally it's called accounts payable. Oh, sorry, it's not 5,000 positive because I'm paying, so this should be negative 5,000. Correct? So imagine, guys, that I made a mistake, $5,000 here. So if you go to your control line column, you're gonna have a 10,000 positive here. So immediately you need to realize, there is something wrong here. Okay, and what is wrong here is basically that I forgot to have the minus 5,000 here. And then we have the control equal to 0. But makes sense to you? So I'm reducing the cash in $5,000 to increase my inventories in 17,000. So this implies that I have $12,000 that I need to pay in the future. Make sense to everyone? Guys, make sense?
Yeah.
Yes.
Perfect. So let me do number 6 because it's also another case, and then you do 7 and 8, and then we can stop there for today, I think. Let's do number 6. Number 6, guys, is I will pay in advance for publicity for the next 3 months, okay? $3,000 cash. So immediately this goes $3,000 here, cash. Can I put this as an expense? Can I write this as an expense? What do you think? So here comes the concept, guys, of payments in advance, okay? So remember that the service has not been yet provided. It's gonna be provided in the next 3 months. So what I've done now is I'm simply paying in advance. So this implies that you have an equity there, you have an asset there, got it? And this is what is called prepaid expenses. So what you have here is a prepaid expense of $3,000. Do you understand what is the concept of prepaid expenses? You have paid
Prepaid
for
card.
something, yeah, you have paid for something that have not yet been provided to you. It's not an expense. It is a prepaid expense. It will become expense later, but at this point, no. At this point, you simply, this is an asset for you. It's more or less like if you decide not to do this, you go to the advertiser, tell them, okay, give me back my money. Okay, if he gives you back the money, simply the asset composition disappears and that's it. Okay, make sense?
Mhm.
Okay, good. Can you do number 7? Let's say 3 minutes to do number 7. Okay, guys. So let's try to understand what's going on in number 7. Okay. So in number 7, we say, okay, we're going to sell merchandise again. Okay. But in this case, we're going to sell part in cash, part in credit, and sales tax is paid in cash. Okay. And this is crucial. The sales tax, the client that is paying you is going to pay the full tax upfront. Okay. So let's try to register this transaction. So I will receive $4,300. You agree?
Mhm.
So that's the cash I will enter. So the first thing you need to realize is how much money I need to keep for the government. Okay, for the government you need to keep $300. Good, I know that. Okay, good. So now I have what is that here? I have cash and credit. Sorry, my mistake. I haven't received this $4,300. Forget about this for a minute. I need to decompose this. I received $2,000 in cash, and $2,000 are going to be paid in 30 days. You see? So this is my 4,000. Sorry, I have received all paid 2,000. I have received this money in cash. I have received 2,300 because I'm receiving 2,000 cash plus the $300 taxes, and I will have a credit of $2,000 for 30 days. Make sense to you guys? Guys, make sense? Up to here, I need to complete this line here. Make sense to you or not?
Yeah.
Okay, good. So remember that these 4,300, 300 are for the government, and of course my revenues are going to be $4,000, correct? Now, to produce these $4,000, I need the cost of goods. So my cost of goods here are equal to 3,500. So I should have negative here, it's an expense. And this reduces what, guys? It reduces what?
Inventory.
Inventory.
My inventory. That's it. So if you go to your control group, control column, oops, we have a 300, oh, sorry, it's not. So what I've done 4,000, oh, it's not, it's minus this one here. Make sense? Make sense to you guys?
Yeah.
Okay, guys, I need more time to do the remaining part. We stay here, we stop here. If you can go and try to read and try to fill out this document here, you know, just understanding, try to understand. Next week, we're going to do all the details and go through all the steps here. And we're going to do another exercise. I want to be sure that you understand every single detail here. And you're going to see how easy this works. Okay, guys, questions? Questions, guys?
Hold
Okay.
on. Sorry. So the difference between item 4 and item 7 is that in
Oh,
7,
oh,
yeah.
yeah, and 7, yep. Is that
Or
I have, here is all cash. Here,
No, I know.
yeah.
No, I mean in terms of the sales tax, because I got a little confused there.
Yeah, the sales tax in this case is 300. Oh.
Yeah, and then
And the other one is 262.33.
oh, so the threes.
I think it's 7.5% of the total. Yeah. In the first case, we sold 3,497, so the tax equals 262. And in the second case, we sold $4,000 in merchandise, so $300 is the tax, 7.5.
Okay. All right, I get it. Okay.
Yep. Okay. Can you please review, guys, up to here? Because these are the main transactions, and the remaining ones are going to be much simpler if we understand all this part here. Please review. And then we're going to continue. We do a brief discussion next week, and then we finish this part here, and in a couple of weeks, we're going to be working this at least a couple of more weeks. So we're going to be proficient on this stuff later. Okay, guys? No questions? No? Okay, so we see you in a week, guys. Please have a nice and safe week, and we continue. Just email me if you need something, and we can continue from there. Okay?
Okay.
Thanks, Prof.
See you guys.
Thank
Take
you.
care.
Bye.
See you. Bye. Bye, guys.